Welcome to Cross-Border Tax Talks, where we discuss the latest trends in international taxation, from U.S. tax reform to the OECD's latest developments. I'm Doug McHoney, PwC's U.S. International Tax Services leader. You can follow me on Twitter at xbordertax. On this week's episode of Cross-Border Tax Talks, we're back in our D.C. studio, where I'm thrilled to be joined by Aaron Junge. Aaron is an international tax director in our Washington National Tax Services practice, and prior to his current role, Aaron served as tax counsel for the House Ways and Means Committee when U.S. tax reform was enacted. Aaron, welcome back to the podcast.
Hey, thanks, Doug. Glad to be here.
I'm glad to get you solo this time and reflect a little bit on your experiences on the House Ways and Means Committee. You were in the thick of the fire. Maybe just a minute on how was that experience? And had to be pretty neat, particularly with everything that happened with reform.
It was pretty neat. It's a lot different than public accounting. I'll
sure.
say that. But it was pretty exciting. It was interesting. We did a lot of different things while I was there. When I started, if we think about, kind of way back when, it almost feels like now, in the House, Republicans were focused on the kind of better way blueprint and a destination-based cash flow tax. And so we actually started working on that,
right,
which is very different than where we ended up.
Yes, it is.
There's a lot of work that went into tax reform before I got there. There's a lot of work that was done under former Chairman Camp in Ways and Means back in 2014 and 2011. But there was a lot of work done, in that kind of second half of 2017 as well. And it was just it was an intense period where we're working hard and trying to get things done.
Right, and we've spent a lot of time navel gazing here on the Cross-Border Tax Talks, and admittedly, I think we are sometimes critical of both Congress and Treasury on some of these, but we certainly know that there are human beings behind all of this, and everybody was working for the best result. But everybody likes to be the Monday morning quarterback, so we can't help ourselves sometimes. But and this is a particular topic that I'm really excited to talk to you about, and this is about attribution. And specifically for the fellow tax nerds who are listening to the podcast, 958B4. But we try not to throw too many code sections around here to keep things at a relatively high level. But really when we talk about 958B4, it's about attribution and determining ownership. And this is something that I really enjoyed in law school, in fact, and it also tells you what kind of person I am, that, in those law school exams in corporate tax, I loved the logic of Section 318 attribution. And for those that aren't as familiar with that, those are the general attribution rules that apply for purposes of determining whether one person, individual, corporation controls another individual, or trying to attribute ownership to determine what percentage of, sometimes it's vote, sometimes it's value, whatever, depending on what provision you might be looking to. But the 318 rules generally provide the architecture for purposes of determining how ownership is determined and whether you have control, for example, and whether it could be reorgs or from an international tax perspective. And then Section 958 are generally the rules that tell us, well, for purposes of determining whether you have a controlled foreign corporation, and then ultimately Subpart F and GILTI, and also the PFIC rules a little outside of that, the 958 rules generally reference the 318 rules. And so before we kind of dive into some of the mechanics, help explain why does 958B4, why do these attribution rules, why are they important for purposes of international tax and in cross-border tax professionals?
Yeah, so if you think about our international tax system, a big part of it is these Subpart F rules, right? Rules with respect to controlled foreign corporations, foreign subsidiaries. And, the name of the game there is to try to identify what is a controlled foreign corporation, which, that concept was created back in the 60s. And back then, Congress was thinking, hey, we're thinking about foreign corporations that are majority owned by U.S. persons. So it's kind of U.S. persons calling the shots because they own more than 50% of the voter value of the foreign corporation. And so you have to have some standard for what does ownership mean. I mean, certainly it means direct ownership, but what else does it mean?
Right.
If me and my brother each own 6% of a domestic corporation, are we both 6% shareholders, or really, is there a greater connection there? Should we be attributed one another's ownership to determine whether we have sufficient ownership? And so, there's a lot of reasons where ownership attribution matters in the international context. But probably the biggest ones are in determining whether a U.S. person is a U.S. shareholder, so whether they own 10% or more of the voter value of a foreign corporation, and whether a foreign corporation is a controlled foreign corporation, a CFC, so whether U.S. shareholders own more than 50%. And, as you mentioned, Section 318 is kind of where the code houses ownership attribution rules. They get used for a lot of different purposes, including wholly domestic purposes. But a lot of times those rules get modified. They get tailored towards a specific purpose of the provision. And that's what 958B does, is it modifies or tailors those specific to the international context in determining things like CFC status.
And so what did, before the change, and everybody talks about 958B4. I think we all knew the 958 rules, but frankly, I'd never been so focused on 958B4, right, until the change from the TCJA. So what is kind of 958B4 first, and then why did it need to change? Yeah,
so, and interestingly, there's also a 958B1, 2, and 3 that no one still pays attention to, but are actually also critically important. But 958B4 was a rule that said, hey, again, we're trying to tailor these ownership attribution rules to the context of CFCs, and what we're trying to do, what Congress was trying to do back in the 60s, is identify foreign corporations where U.S. persons kind of control the foreign corporation, thus the name. And so what 958B4 would say is, look, you don't apply downward attribution to treat stock that's owned by a foreign person as owned by a U.S. person. So think about a foreign individual that owns both stock of a U.S. corporation and stock of a foreign corporation. Typically, downward attribution would say that the U.S. subsidiary owned by that foreign individual owns everything that the foreign individual owns, including stock of the foreign corporation, and as a result, the U.S. corporation wholly owns constructively the foreign corporation. And that can make sense in some contexts where you're trying to figure out whether there's a relationship between the U.S. corporation and the foreign corporation to invoke some kind of a related party rule in the code.
Yeah, because they have a common owner, right? I mean, they've got a common, in your example, foreign individual owner, so obviously they're controlled by both. Makes sense that they are related, kind of in the general term.
And the truth is, you would expect, it may not be true, but actually in the background I gave you, you would think it's true, that foreign individual is kind of calling the shots for both, right? And so, if a transaction happens between the two, then there's that common owner making the calls. But that common owner is a foreign person. It's not a U.S. person calling the shots. And so even though that foreign subsidiary is constructively wholly owned by a U.S. corporation, it doesn't make sense to call it a controlled foreign corporation in this context, Congress would say in the 60s, because it's not U.S. persons calling the shots. And so 958B4 would prevent that result by saying, well, look, because that stock is owned by a foreign person, it will not be treated as constructively owned by the U.S. person under this downward attribution rule.
And if it did, right, then if the U.S. was deemed to control, then presumably you need to think about the compliance requirements, which we'll get into, and that's part of the reason for this discussion was a recent notice that came out. But all those downstream consequences of, in your example, with the foreign individual owning the foreign corp and the U.S. corp, if that foreign corp is a CFC, you need to think about the compliance requirements, and then do you need to test at that CFC level as far as from a subpart F, and now with TCJA for guilty. And one of the things that we'll get into is that only U.S. shareholders have to include their pro rata share of subpart F income and guilty income. In your example, there technically isn't a U.S. shareholder, right?
Well, yeah, there's not a U.S. shareholder with what we call 958A ownership, right? So that foreign person, is not expected to be taxed, subject to U.S. tax on that foreign subsidiary's earnings. But to your point, it could still be subject to compliance requirements or other aspects of the U.S. code that are relevant solely to CFCs. And so it could still matter, and actually we'll talk about a bunch of places where it does matter now, and recent guidance is addressing those circumstances.
So this rule makes just so much sense, right? It's like, okay, why you don't do the downward attribution from the foreign person, because why make that a CFC? Why did they change this rule? Why did 958B4 change? What was the perceived abuse?
Yeah, so it's a great question, and it's actually a pretty narrow concern, which is, we'll get into the conversation we're going to have. But, imagine instead of a foreign individual, imagine it's a foreign multinational with a foreign, corporate foreign parent, and it owns, a bunch of foreign subsidiaries, and it acquires a U.S. target, and the U.S. target has some foreign subsidiaries of its own. And the foreign subsidiaries of the U.S. target are CFCs, on the acquisition date. And, you look at that and you say, well, gosh, if the foreign parent, contributes stuff to the CFCs of that U.S. target and drops the U.S.'s ownership below 50%, because what the foreign parent owns is not attributed to the U.S. subsidiary, that means that the U.S. will own less than 50% of the foreign subsidiaries. They'll no longer be CFCs.
And that's a pretty, just to interrupt, sorry, that's a pretty common fact pattern, right? Like if a foreign multinational acquires a U.S. parent, usually one of the first things that they want to do is integrate the subsidiaries together, because presumably that's one of the reasons for the deal. And so in your example, when that foreign parent takes its foreign subsidiaries, integrates that with the U.S. CFCs, oftentimes it wouldn't be unusual for the foreign parent to then control or have greater than 50% of the vote or value. And what you're saying is because those attribution rules were turned off, now the U.S., those are no longer CFCs. That's before right. The change.
That's right. And, look, I mean, there were and still are a bunch of rules that you've got to navigate when you do a transaction like that. It's not just, you just move boxes around and you're done. There's a lot more to it than that. But at a very basic level, that's the concern, is that, well, gosh, as part of that kind of post-acquisition integration, former CFCs may no longer be CFCs. The U.S. still has a direct or indirect interest, still has some kind of economic interest in the foreign subsidiaries. Now, it may be a diluted economic interest. Maybe it's only 40% of the economics, where it used to be 100%, but it's 40% of a bigger economic pie.
Yeah, so in other words, the value that it owns hasn't really changed, so that you can, to your point, like avoid some of the 367 and some of these other issues, because there are a myriad of other issues. We oversimplify things sometimes here on the cross-border tax talk, so it's a well, good point.
But the concern that was had was, well, it's really kind of three concerns. The first one is historically, there was some concern that, well, maybe this wasn't appropriate, that, the U.S.'s interest, the value of its interest hasn't changed, but, solely by reason of having a foreign parent that now has a controlling interest in the in the foreign subsidiary, there's no longer an application of Subpart F. So there's some question about whether that was an appropriate, operation of the rules in the past, and whether a policy change was warranted there. But where I think it was really exacerbated in the context of reform is, one, toll charge. Mm-hmm. This is the most significant Subpart F inclusion you're probably ever going to have. And the purpose of it is to say, well, hey, you're transitioning to a new world where distributions are going to benefit from a DRD, from a participation exemption. And, it seems inappropriate for that U.S. subsidiary in that case that owns, 40%, let's say, of that foreign subsidiary, to not be subject to toll charge, but to benefit from the participation exemption on a go-forward basis. It seems like it should be subject to the same toll charge as a U.S. multinational, for example, that owns 100% of the foreign subsidiary.
And to remind people, the toll charge is all of that untaxed D&P from our pre-tax reform system that was deferred from U.S. tax until it was brought back to the U.S. And so as part of the cost of moving to this quote-unquote territorial system, the toll charge is all of that accumulated earnings and profits that was earned offshore that was immediately subject to U.S. tax as part of the transition to reform. And you're right, if that wasn't a CFC, then even those historic earnings that were earned while it was a CFC wouldn't have been subject to tax.
Yep. And the other issue, which you've already kind of alluded to with your kind of quote-unquote territorial, which we can spar later about, but the, undeniably a significant feature of the new international rules post-TCJA is this regime called GILTI, which subjects a significant amount of foreign earnings to U.S. tax, or at least brings on the U.S. return. And, it's one thing to say in the past, well, guys, you're going to avoid Subpart F, which frequently is a small slice of foreign earnings.
Right.
But to say you're going to avoid GILTI, which could be, 80, 90, 95% of your foreign earnings, that kind of exacerbates the concern, and so it made a lot of sense to really look at this and find a different solution. And the solution was, well, if the problem is that the foreign parent's ownership in the foreign subsidiary is not being taken into account because of 958b4, well, let's knock out 958b4, and that takes care of the problem. The concern, of course, and we'll talk about it more, is 958b4 did a heck of a lot more than allow for this particular result.
Yeah, so let's maybe get to some of those downstream consequences, and also, I guess, let's start with the downstream consequences of that, and then we can talk about, because I know there's also been some proposed legislative fixes, which we've talked a whole lot on the cross-border tax talks in a number of different sections where there have been proposed, legislative fixes, but obviously there hasn't been much, if any, headway on that, given all the the stalemate that we have in Congress today. But maybe talk about some of those downstream consequences first.
Yeah, and so there's a lot of places kind of littered throughout the code, really, where a CFC status creates a different rule. And the idea is, well, we've got a specific rule for foreign corporations, but when it's a controlled foreign corporation, Congress is thinking the U.S. persons are calling the shots, and so it's different than kind of your typical foreign company that doesn't have a lot of U.S. involvement. And so an example that was actually a pretty prominent example was Section 267A, which is a rule that says, amongst other things, that in general, payments made from a U.S. person to a related foreign person are kind of on the cash method, that they can only be deducted when a payment is made. Now, that rule extends to a broader scope of payments when it's made to a CFC, with the exception that if the amount is taken into account in a U.S. shareholder's Subpart F inclusion or after TCJA guilty inclusion with respect to that CFC, then you can take the deduction when the income is accrued and taken into account by the shareholder as opposed to when the payment's actually made. But if you go back to, kind of a simple example where the foreign multinational owns a U.S. subsidiary and a whole bunch of foreign subsidiaries, well, once you allow downward attribution to apply, every one of those foreign subsidiaries becomes a CFC, right? Because, the U.S. subsidiary owns everything that the foreign parent owns. Well, foreign parent owns all these foreign subs, so the U.S. owns all these foreign subs, so every one of them is a CFC. There may not be Subpart F or guilty inclusions with respect to those. There very well could be, depending on what your full ownership structure looks like, but there may not be. But even still, just payments from that U.S. subsidiary to the foreign affiliates could be subject to this kind of cash method where the deduction for that payment is not allowed until a payment's actually made, even though the income's being accrued on the other side, perhaps for foreign tax purposes as well, but it's not being picked up in anyone's Subpart F or guilty inclusion necessarily. And so it just results in this kind of deferral of a deduction from the U.S.'s perspective until an actual payment is made. And, that rule can make sense in certain places, but it doesn't make a lot of sense here, and it certainly wasn't within the scope of what Congress was getting at. Again, the kind of point of 958b4 repeal was to get at these, structures where a former CFC ceases to be one because of related party ownership, and that has nothing to do with, cash or accrual method for payments made by U.S. to foreign affiliates. It's simply unrelated and just creates kind of an unintended result, and actually a pretty significant one for a lot of inbound taxpayers.
Yeah, and so that's just the example of one with 267. There are a number that were of other provisions, the 332, 367s, with the PFIC rules, and so. But I think that's a great example. Before we talk about the proposed rules, one of the things that have been proposed as far as a legislative fixes, maybe talk a little bit about, is this something that should or could be fixed or will be fixed from a legislative perspective, and then we'll turn immediately then to what Treasury has done to try to alleviate the downstream consequences of this.
Well, so I can't say, and I'm pretty sure no one can say what will happen, right? It's always up in the air. But, maybe just to back up a little bit. So, I view tax reform as really, having its roots in kind of former Chairman Camp's work back in 2011. 950B4 repeal was not part of that. It wasn't part of the 2014 Camp bill, as I recall. It was part of a prior Obama-era administration proposal, to address this circumstance. But, alleged text, I think folks first saw and kind of recognized what it was going to look like on November 2nd, 2017, when Ways and Means Committee put out the chairman's mark to go into markup and start marking up the bill and thinking through what the legislation would look like. And immediately, maybe not November 2nd, but certainly November 3rd, we got lots of calls. And we got lots of calls on lots of issues, right?
I'm sure.
But calls on this too, and people immediately started pointing out, hey, get where you're coming from, but what about this fact pattern? What about this fact pattern? What about this fact pattern? And each fact pattern you saw, you're like, yeah, that's not really what we're getting at. Yeah, that's not really the point. Yeah, that really shouldn't be covered. And some of them were very egregious. Actually, an example of one in the proposed regs is oceanic sourcing of oceanic income. And actually, you can get in a circumstance where a company's income is subject to a 30% gross basis U.S. tax. It's not the ECI rules; it's the FDAP rules that your profits that your revenues are subject to. You're paying a 30% U.S. Gross basis U.S. tax, which and your profit margin might be like 8%.
Right.
You know, like the tax is like quadrupling the profits. It's extraordinary, and it's nonsensical. And so there was an immediate reaction that something needs to be done here to kind of narrow the scope of this. Now, that was a challenging period because there's a lot of issues going on. You think November 2nd is when the chairman's mark came out. December 22nd is when the president signed the bill into law. I don't know how many days that is, but it's like 50 or something.
Yes,
it's not very many, right?
Not very many.
And so it's you're working through a lot of challenging issues, and this one included, and within that 50-day window, if that's what it is, conferencing the House and Senate bills was like 2 weeks, right? It was even smaller, and so it was very challenging to find solutions to everything. And this is an example of something where, during that period, although there was great concern and about what the scope should be, the ultimate legislation didn't have a change in the provision here. Now, there is quite a bit of legislative history that describes exactly what Congress was getting at, and I think makes it very clear.
It does.
That a lot of these collateral consequences are not within the intended scope. But since then, what we have seen is former Chairman Brady, formerly chairman of the Ways and Means Committee, put out a rules amendment at the end of 2018 and a discussion draft at the very beginning of this year for potential technical corrections to Tax Cuts and Jobs Act that address a whole host of issues, including this. And in addition, there's actually bipartisan, bicameral legislation that was introduced in the last month on specifically this issue. You've got members from both sides of the aisle across the political spectrum identifying this as something that there should be a different path forward. And what those provisions do is they reinstate 958b4 and provide a new provision that would more narrowly target what Congress was really getting at back in 2017. Until we see now, all those proposals so far have been aimed at being retroactively effective to the scope of 958b4, so the last year before 2018, typically your 2017 year. Until Congress acts on one of those and we get some of that legislation, taxpayers are left in a tough spot because they've got a statute that many would say is relatively clear. They've also got a significant body of legislative history that many folks would say, clearly demonstrates what Congress's intent is. And so taxpayers are left struggling with, how far do I take the statute? How far do I take the legislative history? And hey, Treasury, is there anything you can do to provide us some relief here and better harmonize, the code with congressional intent?
So that brings us to then these proposed regulations that we got within the last several weeks. Broadly, what are those regulations tell us?
Yeah, so there's two parts to what the guidance we got recently. There's proposed regulations that you mentioned, and there's also a revenue procedure that we'll talk about. The proposed regulations, what they are getting at is largely identifying other provisions in the code that Treasury believes were not intended to be affected by the repeal of 958b4, and basically providing regulatory relief to effectively reverse the repeal of 958b4 where it shouldn't have been having an impact. So we just talked about Section 267. That's an example. The proposed regs come in and say, hey, downward attribution from a foreign person will not apply for purposes of applying these kind of CFC-specific rules that turn on CFC status. And that's one example, but there's actually, as you mentioned, a kind of a potpourri, if you will, just various issues.
The Oceanic one was one of the examples
right.
as well in there.
That's right. Yep.
And when are those regulations effective, right? So because we had companies that were filing tax returns, and I know the RevProc actually gets into some more of the filing pieces, but broadly, I think, did they give us retrospective relief or to be able to rely on those proposed regs, if you will? Yeah,
so, and we've talked about this before on this podcast, is they can't provide mandatory retroactive effect at this point, right? There's the possibility of kind of retroactive regulations if they are within 18 months of legislation. We are past the 18-month mark for TCJA. So these regs can't be, by their terms, retroactive. So they have some level of prospective effective date. But what they provide is reliance language that taxpayers can rely on these regs. As long as they rely on them consistently, they can rely on these regulations retroactively consistent with the effective date of the repeal of 958b4, which is the last year before 2018, typically your 2017 tax year.
And presumably, and you know a lot more about this procedural aspects, it's like because this is consistent with legislative intent that was reflected in the legislative history as kind of how Treasury is able to kind of go back and allow taxpayers to rely retroactively on regulations that hadn't been issued yet.
Yeah, I actually think I think that's supportive, but I'm not sure that's actually necessary. I mean, the reality is, as long as it's elective, as long as they're not requiring taxpayers to be subject to retroactive rules, I think they have some flexibility to say, hey, we'll allow you to rely on these retroactively. Certainly folks aren't going to challenge, the ability to rely on a regulation. Now, they might the taxpayers are more likely to challenge, a retroactively effective regulation that they have to apply. I think it's true, your point, that it's consistent with congressional intent, and that's helpful, but it may not be the sole standard.
I guess the other important point is that this is taxpayer friendly too, so we don't anticipate many taxpayers kind of arguing for retroactivity or some of the procedural aspects, but never say never, I guess.
Well, and to be fair, most of the package is taxpayer friendly. I agree with that. There are a few pieces that are not. There's a few pieces where folks may have been expecting a benefit. I'm thinking about, the foreign tax credit look-through aspect. I'm thinking about, I don't know how many people were working with these, domestic holding company liquidations, but, something like that could be viewed as taxpayer unfavorable.
Fair enough.
So not really expecting people to rely on that retroactively. I guess they could if they want to. That's a call for each taxpayer.
Yeah, and I think many of us that advise or practice in the area, particularly on the look-through rule, were a little hesitant on kind of relying or weren't that surprised that we weren't able to rely on the 954C6 look-through for these quote-unquote CFCs that were created from 958B4. So maybe let's turn here at the end towards the Rev Proc, because I think that one of the really big issues about this that I just heard as I travel around the country talking to clients and doing panels was the compliance aspect of this. And all of a sudden in your example where you have a foreign multinational that's got foreign subsidiaries all over the place and acquires a U.S. company, well, then that U.S. company now has all these CFCs, and consequently, as a result of you have to file 5471s, and then, well, how do you get the information? And then if there's split ownership, for example, or minority ownership, it just created a whole lot of questions and headaches from a compliance perspective. But talk a little bit about the Rev Proc, and I know it covered some other issues as well.
Yeah, so there's definitely a lot of compliance-related concerns that arose from the amendment to the downward attribution rules. And, shortly after tax reform came out, beginning of 2018, there was a notice that came out from the IRS that said, hey, if you've got a CFC by reason of 958B4 repeal and, there's no U.S. shareholders that would actually have an inclusion with respect to this thing, then you don't need to file a Form 5471. We're gonna amend the instructions to provide that relief, which makes sense, right? You think about your typical foreign multinational; they got hundreds of foreign subsidiaries, and no one's going to have any inclusions with respect to them. Great, no need to file a Form 5471. That makes sense. But that's not going to provide relief for everyone. And just think about that same foreign multinational. But imagine that they're publicly traded, but 15% of the public float is owned by a single U.S. person, right? And there could be a whole bunch of kind of strategic reasons or historic reasons why that's the case. But that 15% shareholder, well, they're a U.S. shareholder, and they are running the risk that there could be an inclusion with respect to all of those foreign subsidiaries, right? They've got to work through the statute and the legislative history and think about what it all means, but there's a risk that they could be having to pick up a subpart F for guilty inclusion with respect to all of those.
And to your point, before 958B4, that 15% shareholder would have been a U.S. shareholder, but without the attribution from the U.S. group, it wouldn't be in a CFC. And then with the change in 958B4, now that 15% U.S. shareholder now has all of these CFCs, which is this myriad of foreign subsidiaries that have no relation to the U.S. company. And how does that 15% shareholder get the information that he or she or it needs to actually determine it's guilty, subpart F, file the returns, et cetera?
Yeah, no, that's exactly right. And look, they're a public shareholder, just like the rest of the 85% float, they're. And so how do they figure out, entity by entity information, related party transactions, whether someone had a busted 351, how do they figure this stuff out? It's incredible. And so the RevProc does provide some relief in that respect. Now, it does require being very careful. Taxpayers need to be very careful in defining, what they are within the nomenclature of the RevProc as far as what relief they get, and also whether they qualify for the relief, because it's very specific as far as what the RevProc allows. But in those circumstances where you're, an unrelated 958A shareholder in the nomenclature of the RevProc, but unrelated to the U.S. Subsidiary down below that's causing the CFC status, but you are a U.S. shareholder, you have the ability to use alternative information that's readily available. So you don't have to use the information typically required for a Form 5471. You can use something like single entity audited GAAP financials or something like that to get closer to use information you have to get close, but maybe not exact to what the rules typically require. And so that can be welcome relief where folks qualify. I will tell you, a lot of folks don't qualify for that because even that information is not available. You think about publicly traded entity, they don't have single entity information. You get consolidated information. That's what IFRS or GAAP gives you. And, so it can be a challenge even for others, but there's some relief in there for those circumstances. The other piece I'll just mention, and I don't want to take too long on it, but some folks, have really struggled with whether they even have an investment in a CFC, right? You think about, you're investing through an investment partnership or a fund or something like that, and any of the other investors, if they have an investment in a domestic corporation, then downward attribution could cause your investment to become a CFC, but you have no idea because you don't know what all the other investors invest in, right? There's no way for you to tell. And so another very welcome piece of the revenue procedure is you don't have to inquire as to other shareholders whether they have investments that would create CFC status. There's a safe harbor for determining whether it's a CFC, and it basically requires an inquiry into the entity you have an investment into.
And that was obviously for the financial services and asset management sectors welcome news because that was a big potential issue. Well, Aaron, this is fascinating. I mean, we're just kind of at the tip of the iceberg given the complexity of some of these rules, but I think you really did a great job kind of explaining these, and a little bit of insight from your experience while these rules were created was very insightful. So I appreciate that.
Well, thanks. Glad to be here.
Well, so thanks for tuning in to this week's episode of Cross-Border Tax Talks. Thank you to Aaron Junge, an International Tax Director in PwC's Washington National Tax Practice. I'm Doug McHoney, PwC's International Tax Services Leader. Stay tuned in 2 weeks for another exciting edition of Cross-Border Tax Talks.